Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Welcome to the latest podcast, everyone. Craig Stent is joining me today, and he's a founder of Harbour Asset Management and head of Harbour's Equities team. Furthermore, he provides equity research and ratings on the utility sector, which has been an important one for lots of investors in New Zealand. And Harbour's one of the active fund managers chosen by ASB to manage Australian equities in our portfolio series of investments. It's great to have you on the podcast, Craig. I'm really looking forward to hearing your thoughts on the local share market and how you think the economy and businesses are tracking. So welcome to the call.
Hi, Chris, and it's great to be online and to share our thoughts about where we see the world at the moment.
Yeah, I'm sad that we're still not at the point where we can get back into the studio. I'm working from home. And funnily enough, today was the day that the next door neighbours decided to start renovating their house. So I've asked them if they could just cut the sanders and the buzzsaws down for half an hour while we record this. But hopefully over the next week or two, we'll be back in the office. What are you and the Harbour team doing in terms of working from home back in the office these days?
Yeah, it's a good question. We've got a couple of offices where most of the people are based in Wellington. Pretty much everyone's been back at work since, after Christmas. Clearly there's been a few people that have come and gone as they've succumbed to the virus, I guess. But yeah, everyone enjoys being back in the office and some people work from home occasionally, which I think works in with people's lifestyles and helps them be a bit more productive and work on certain projects from time to time. So it's I think that flexibility is here to stay in the corporate workforce.
Yeah, it's certainly nice to avoid the morning traffic jams here in Auckland, but on the other hand, I'm looking forward to a bit more networking, and particularly if the next neighbours renovations go on for a few months like they inevitably do, maybe that'll be my catalyst to put up with a bit of driving and to get back to work. Hey, and you've been at Harbour right since the beginning, right? And so tell us a little bit about your role at Harbour and how it's evolved over the years.
Yeah, it's a great question. I've been here since 2010. It seems like yesterday we started the business up. The core team of the equity team were part of a global company called AllianceBernstein in the day, and they decided, as big corporates do, they decided to shut the New Zealand business down, and so we still wanted to do what we were doing, so we managed to set up the business and get some support from another investor that help get us going. And now we've been going for 12 strong years, and we manage about $7.5 billion across different asset classes. And I guess my role was, and principally as we started the business out, was as an equity house managing money for clients and institutions like ASB and so forth. And it's clearly evolved. Since then, the business has grown from strength to strength, and now we number some 32 people and constantly growing, it seems. And I guess it's one of the conversations we're having today about is, difficulty in finding people and strength of the labour market, inflation, and etc. So some of those, clear issues of we're facing on a day-to-day basis, I guess are very familiar topics for a lot of people.
Yeah, I'm looking forward to discussing what some of the businesses you deal with and how Harbour's tackling some of those challenges. One of the things I really enjoy about Harbour is the research notes that you publish on your website. I enjoy reading them. They're really insightful, and I encourage listeners to have a look. And I want to start with a note that you recently published called Inflation, Rates and Conflict: The End of Free Money and Globalisation. That's a punchy title, and it sums up an awful lot of the issues that investors are grappling with on top of the pandemic, or maybe intertwined with the pandemic. So if it works for you, let's chat about some of the points you've been making before we get into how businesses went over and the share market went over the first quarter. How does that sound?
Sounds great, Chris. Great flow.
Cool. Well, shall we start with inflation? And one of the things that someone said, can I ask you, is are we in stagflation, which is a scary word for any economist to think about. So let's keep it a bit simpler than that and say, how has your thinking about inflation evolved over the past year or so?
Yeah, that's. I think this topic has certainly evolved materially over the last year or so. If we rewind the clock to about this time last year, there was this whole buzzword around transitory it was a bit like the word unprecedented at the time. It came into vogue and then kind of disappeared again now, because this transitory topic, I guess, is to some extent become a little bit more embedded, and that's clearly something the central banks around the world are really worrying about now. Clearly, a couple of years ago it was COVID-related issues, supply chain disruptions that were shocking the world, I guess, from that perspective. But now we've had the conflict in Ukraine, which has created or elongated some of those supply channel disruptions. But also, I guess, as we reopen up around the world, there's certain tensions around that, people's appetite for consumption, getting back into the labour force, the tightness of labour markets around the world. And I guess the lifting of inflation expectations is the key thing that central banks are probably grappling with at the moment, and how they can get on top of that. So certainly this topic has evolved. In terms of stagflation, I think that, I don't think it's a base case for many people, but it's certainly an area that we need to be very mindful about, because that conversation is rapidly developing as well, as the data potentially comes out a bit softer and inflation prints become quite elevated, as you've talked about many times yourself before, Chris. That these numbers are quite eye-watering, really.
Oh, yeah, the inflation pressures are so strong, and the dynamics keep changing, don't they? One of the things which has helped with the labour market here up until the pandemic was migration and getting people into plug skill shortages. And we've learned heaps over the past couple of years of how important short-term visitors are to industries, including fruit picking, all the way through to hospitality. And it's interesting now that borders are starting to open. Rather than thinking this will be a solution to the labour market, the conversation shifted to, well, maybe this will be even more pressure if Kiwis start travelling. So it's comes back to that word about unprecedented times, or certainly very challenging and hard to predict times. In the mix, are there pressures that you think can ease over the coming months? And what are the aspects that you think are looking more problematic, both in terms of your own thoughts and things that businesses are perhaps saying to you that they're worried about some of these capacity and inflation pressures that businesses are dealing with?
Yeah, I think some of these, at a headline level, some of these pressures will ease from a statistical perspective in terms of the headline numbers. And I mean, if you point to the US, we've seen used car sales. Who would have thought you can get more for your used car than just about what you paid for it? And then we've seen things like rents, etc., go through the roof. And they've been a large contributor to the underlying numbers of the CPI. And clearly the goods demand that we, got crazy about post-lockdowns, that everyone was going out, whoa, we can buy all this stuff now. We've got this pent-up savings that we just want to go buy another TV or some other widget to have around the house. So I guess that sort of demand side for goods is probably going to naturally wane a bit, because you don't need that many TVs in your house. But there'll still be pressures that are flowing through. I mean, commodity prices more broadly, energy costs, all this stuff is going to flow through to finished goods and to a lesser extent services. And so those impacts aren't going away anytime soon. If anything, they're going to be a little bit more elongated. And we're still seeing supply shortages across, technology space, semiconductors, etc. And the transport and supply channels seem to have let up. If anything, if readers have been, or listeners have been reading the news about, in Shanghai and China and their determination to have a zero-case policy in their local economies. In terms of Shanghai, we're seeing ships normally around 100 ships off the port of Shanghai, and that's now leapt to 300 or so. So you've still got these disruptions that are, I guess, permeating out there in the market. As you touched on, Chris, labour is a big issue here locally in New Zealand, and it's a thing that corporates are going to really battle with, and I think they're starting to battle with now. I mean, we face in our own business trying to find staff. It's a very tight labour market, and with limited migration, and if anything, it's migration going the other way, the brain drain that you talked about, as young people might want to travel overseas, or with better opportunities in other markets for people to build wealth and extend themselves. I don't think that issue here locally is going away at all. Maybe that means that companies have to think about, sort of process improvements or productivity gains. Maybe that's investing in technology, but that doesn't happen overnight. You still need to plan for that, and it does take time, but it might ease the pressures over time, marginally.
Yeah, when we look at the recent business opinion surveys, there's just so many cost pressures coming through for businesses here in New Zealand, and just massive numbers of businesses that want to put up prices, and that's behind ASB's forecasts for the Consumer Price Index to get over 7%. What are the key businesses in New Zealand that you're looking at and talk with, thinking about the outlook and their ability to both absorb or pass on these price pressures? Do you think that very high level of businesses that are saying we're going to put up prices will be actually able to do it?
Yeah, I think to some extent, New Zealand corporates will give it a go and see what happens and see if they can pass on those costs where possible. And clearly we are very much, if you think about manufacturing or goods businesses, we very much are the whims of what's happening globally with, as we talked about before, supply channels, and some of those costs is passed on anyway. You have no choice, right? And it's probably a little bit part of the reason why we're a little bit cautious about the consumer here in New Zealand and probably in Australia, but that's probably 6 months away. You have to worry about that. It seems to be a little bit out of cycle with New Zealand, but the ability for some of those companies to pass on that, well, they might try. Whether it sticks or not is another story. But if you think about other companies which have large labour components, demands for wages is obviously lifting as well. And what capacity do they have to pass on the labour costs? In some cases might be quite challenged.
Yeah, when we look at the mix and particularly households' ability to deal with their cost pressures, it's probably the discretionary spending area that we worry about the most. The labour market looks pretty strong in terms of the total level of employment, but people's budgets are definitely getting squeezed pretty hard, and things like higher fuel costs are just a tax on households. So it's some of those discretionary things that we've been buying, and those big ticket items that, like you say, that we perhaps don't need to buy every year, but we've certainly bought a new barbecue or what have you, or a TV with the money that we've saved during lockdown. So that's an area where we're carefully looking at when we think about the outlook for the year ahead. So the other question we get with this inflationary environment, but also these growth threats, is central banks and their responses. And as you mentioned in your note, there's been a real pivot. And as you say, a regime change really from a period that goes back to the global financial crisis, where central banks have had our backs, if you like, and done what it takes to support growth and essentially kept rates low. And now it feels like we're at the start of the first decent tightening cycle for many, many years. Have you been surprised at the swiftness of the change that we're seeing for central banks? And one of the swift ones was this week with the RBA. That's definitely changed strategy, but the Reserve Bank's probably gone from being what felt like an outlier and a quick changer last year to more of a trailblazer. So what's your thoughts on the pace of the change that we've seen?
Yeah, it's been, as I think we described in the note, it's been warp speed, the pivot or change from central banks globally, and they're reacting to the data prints that are coming out on inflation. So they need to get on top of this. I found a good quote from the former Fed chair, Ben Bernanke, from 2011, actually. It was, and it's probably quite relevant today as well. And it went something like this. The Fed can't create more oil. We don't control the growth rates of emerging market economies. What we can do is basically try to keep higher gas prices from passing into other prices and wages throughout the economy and creating a broader inflation, which would be much more difficult to extinguish. So I think that quote's dead right, even though it's 11 years old. What central banks don't want to see is this inflation prints getting embedded into inflation expectations and other transmission mechanisms like wages. And so what we're seeing in this policy response from central banks is moving from extremely stimulatory emergency settings to something more neutral. And depending on the reaction of the inflation numbers, they might have to go into a tightening bias. So I think we kind of need to remind ourselves that we have been at these ultra-low interest rate levels, and central banks are just moving back to perhaps a more neutral stance.
Yeah, I agree. It's really interesting to listen to a quote from over 10 years ago and think, yep, that still sums it up though. And these are still historically low interest rates that we're dealing with. But having been able to access a 2% mortgage, a 5% mortgage seems very, very expensive. But for being in my 50s, most of my borrowing life, I'd be very, very happy with a 5% mortgage, particularly having paid a 10% mortgage at one stage. And there's probably some listeners out there that have said, nothing, son, I've paid a 20% mortgage. But we still are in a low interest rate environment, it feels, but nowhere near as low as what we've come through. And that brings me to a question about local interest rates. And when you look at market pricing and where interest rates are that borrowers face and that businesses face, for rates and equities, do you think equity prices have adjusted to this big movement in bond yields and the underlying assumptions about where central banks are taking interest rates?
Certainly the interest rate market has moved, and the interest rate curves further out have moved materially. And we have seen this reaction function, I guess, from banks like yourselves that are also lifting mortgage rates, longer term mortgage rates, etc. So still what we need to see is that, I guess, the reserve banks of the local economies or central banks move the official cash rates and deliver, I guess, on these the embedded tightenings that are priced into the market. And in some ways, the markets are actually probably embedding a probably too much tightening in further dated interest rate settings. But I guess that's the tug of war that's going on between growth and inflation and central banks. And I think from an equity market perspective, we had this large drawdown in the first quarter across most markets, actually. And that was, I guess, investors readjusting to these higher interest rates and how that affects the valuation of perhaps more longer dated companies, which might the profitability of those businesses is a bit further out. And you can see that, I guess, with the performance of those more sensitive markets to interest rates like the NASDAQ in the US, which had obviously a reasonable drawdown in the first quarter. So I think there has been a reaction to the repricing of interest rates. I guess the key unknown, and we've seen it again this week, is the interest rate curves continue to sell off and go higher as they react to, I guess, more comments from the Fed around, where this quantitative easing concept, and now we're reversing that and going into quantitative tightening. And what does that mean for, I guess, liquidity and financial conditions in the US more broadly? So I think we've seen a big adjustment in terms of the interest rates and effect on equities. But if we see a further elevation or increase in interest rates, it still makes the equity market a little bit wary about the pricing of some of those companies.
Yeah, and from many years in working in the dealing room, when interest rates get a bit of momentum in one direction, sometimes it can carry on for quite a while, but not necessarily give you a good guide about where things will settle. And things like a 10-year government bond has come so far in a short space of time, but are starting to get a little bit ahead, in my view, of where they should be if inflation in the long term isn't a big problem, and central banks like the Reserve Bank of New Zealand can finish their tightening cycles with official cash rates below 3%, for example. But let's turn to corporate New Zealand, and you've highlighted what you think about the interest rate and inflation environment. And so I'm interested, you're an active fund manager, and out there trying to choose businesses that you think will do well. So what businesses in New Zealand and within your portfolios do you think are positioned well for this interest rate and inflation environment? And are there any sectors or that you're worried about at the moment?
Yeah. So we can invest across New Zealand and Australia. And we're principally a growth manager, so looking for companies that can grow their earnings through various parts of the cycle. And some of the companies we're looking at, I guess, to some extent are not immune, but not necessarily affected by what's happening in the economic cycle, as they have the great product or business that they can grow through all markets. But I think in New Zealand, we're looking for companies that can have pricing power and that can continue to grow their revenue and maintain margins against the face of other increasing costs such as staff or supply channels, etc., or just natural goods pricing that they might have as part of their process. But I think some of the companies that we invest in, and examples here are Mainfreight, EBOS, and to a lesser extent Fisher & Paykel Healthcare. They are global businesses that are growing their business in various markets, and indications from some of these companies is that they can manage to pass on the cost, or that the cost increases is relatively small relative to their overall margin or sales. So they got the ability to pass that on. At the other end of the spectrum, we've got companies that are highly exposed to the consumer, have high labour content, they might have very high transport or freight costs. And some of the areas we think about here is, the retailers, aged care sector, which has a high labour content, delivering care services into people. And they're also struggling with the labour shortage as well, because many of these people, can immigrate or have immigrated from other parts of the world. We're yet to see an impact of these influences on the company profitability to a greater extent, but I think some of that is still ahead of us and from an earnings perspective of some of these companies.
And how about some of the businesses that potentially can benefit from borders reopening and people travelling more? I'm thinking of the likes of Air New Zealand here or Qantas across the Tasman, the airports, which have had such a hard few years. Is it possible to start thinking about a better outlook for those businesses, or do you think there's still a lot of uncertainty for them?
Yeah, it's a very good question. How many flights you booked so far?
I booked them on very short-term basis because of the uncertainty. And one of the funny things, I've always wanted to do the Milford track, and I've never managed to get a slot, but I did it this year. So that was a COVID success for me.
Right.
But it was up in the air right until the last minute, and it was amazingly cheap compared to, to travel and book a hotel compared to earlier trips down to that beautiful part of New Zealand. So it's very hard to know if the clouds have cleared, in my view. Is that how you feel?
Yeah, I guess at a high level we can segment the market, and people have done this in the last 2 years into, I guess, the COVID losers and the COVID beneficiaries. We are coming out of this COVID, I guess, loser phase as the variants decrease in the impact, and we can potentially open up New Zealand to the rest of the world. So anything that's exposed, as you touched on, to travel, tourism, or open borders has been clearly hit. Air New Zealand, Qantas, but there's also companies like Tourism Holdings here in New Zealand, the campervan company, Serco, which provides travel software effectively for travel agents and booking.com, etc. So if travel's down, these guys don't necessarily benefit from a user's perspective. Another company we own in the portfolio called Ramsay Healthcare, which is probably one of the largest private healthcare companies in it's Australian business, but in Australia and France and Europe. And they've been limited around the ability to do elective surgeries because their facilities have been taken up or basically commandeered by the governments for other healthcare services. Obviously, SkyCity here in New Zealand, in Australia as well as other examples of companies that have been hit from an earnings perspective because their businesses have been disrupted. You clearly think they should benefit as the world reopens, but as we just talked about briefly, Chris, there's still a lot of unknowns about people's appetite to travel. Are you going to book a flight for your family to go to Europe for 6 weeks and the hassles that might come with that around testing and insurance and everything else that goes with it? So it's not going to be an easy journey, I don't think. It might ease up over time as people get a bit more comfortable with it, but I think sort of long-haul travel might be another 12 months before that really gets off the ground. You might go to Fiji or Australia for a holiday, but I think that long-haul stuff is probably a bit more tricky.
Yeah, I agree. My father lives in America and has lived there for over 30 years. Although travel's possible, the bit that concerns both of us is, are we going to get sick from it? And if we do, where are we going to get looked after, and who's going to pay for that? Particularly going to America, it's not a cheap place to need hospital care, that's for sure. And I think those uncertainties will impact people's appetites.
And I think some of this reopening trade that everyone's talking about, some of these companies that might benefit, it's not necessarily lost on some of the share prices. And clearly in the likes of Air New Zealand, we've had a large capital raising that has to be digested by the market. And that's basically just get the company back on an even keel so they can actually open the doors and run the business without needing government support. And the likes of Auckland Airport, it's that share price pre-COVID was sort of $8.50. It went down to $4.60 when they raised a lot of money, and now we're back at close to $8 again. So there is a lot of, embedded expectations, some of these companies, that the earnings are going to rebound and life will be back to normal. But there's still a lot of uncertainty out there that we have to contend with.
It was very weird to go out to the airport for my trip that I mentioned. It used to be pretty much a weekly thing to be out at the airport and dealing with traffic and queues and all that sort of stuff. And it was almost surreal to go out there and fly after such a long time of not doing too much travel. And that's just domestically. The international terminal looks even stranger, but hopefully some of that pricing in the share price proves to be correct and things do pick up. Changing subject a little bit, we've already built up a bunch of uncertainties and things for people to worry about, and then we've got the horrible situation in Ukraine to add to the mix, and a lot of investors have been asking us about the impact of the conflict in Ukraine on New Zealand and on markets. And my first answer as an economist is New Zealand doesn't do a lot of trade with Russia or Ukraine, but direct trade's only one of the channels. We've got what it means for confidence, what it means for commodities that we're interested in buying elsewhere. And clearly the two countries are impacting commodity prices and impacting confidence in financial markets. Do you ponder the idea that this war could mean that central banks take a more gradual approach to interest rate settings, or are you in the camp that they've just very much focused on inflation at the moment, and this is just some background stuff that they have to deal with?
Yeah, I think straight up, I don't think that they necessarily are going to change their approach, the central banks, because of the Ukraine. I think they've acknowledged that in their last meeting when they said that the conflict has taken a chunk off growth with the disruptions, but they are primarily focused on inflation and taming the inflation expectations. So I think they're still going to forge ahead with interest rate increases. And I guess many of the cases you've seen in the last probably 100 years, conflicts happen and then they cause an issue, I guess, in terms of market volatility and risk aversion. And we've seen it again this time around. And there's a bounce in expectations or bounce in risk assets. And we've seen that, I guess, bounce back in equity markets as well. As horrible as the conflict is for the humanitarian aspect of it, sometimes just with time it becomes less of a topic that people need to worry about or focus on. It's not the front page of the newspaper every day.
Yeah, I think one of the things that I remind myself of time and time again is that investment markets never wait for all the clouds to clear before they start to find direction, and that certainly felt like what was happening in March. It was actually a reasonable market month for equity markets in particular, even though the front page of the newspaper looked as bad as ever when it came to news coming out of the Ukraine. It's just a tough thing that we're having to watch, and I hope things improve over the coming months. Talking about sort of global events, and within your report, the final point about globalisation, you point out the move towards globalisation that really started with the fall of the Berlin Wall is coming to an end. What do you think some of the key events that are signalling this deglobalisation, I guess we could call it, or the fact that the peak period of cooperation is perhaps several years behind us?
I think if we rewind a couple of years to perhaps Trump antagonising in China in terms of tariffs and other things, I mean, that might have been the start of it more broadly. And now with the Russian-Ukraine crisis has clearly increased the geopolitical tensions around the world. And then there's a lot of countries who happen to take sides effectively and show a coordinated effort in some regards. And where we're not so certain perhaps is what China's approach is going to be. Clearly they can see, they've got potential ambitions for what they see Taiwan as where it belongs. But I think they're probably being surprised by the reaction by the West largely in terms of sanctions and other controls that they're taking. So that might be hopefully off the table for now. But I think countries have to think about a lot of things now, how they engage with the rest of the world, how they trade, who they want to trade with. Obviously, security supply of energy is a massive thing, particularly in Europe. And we've seen a massive push by the Germany, the Frances of the world to look to in-source energy generation. There's lots of renewable projects that have been talked about. And this is great from, a decarbonisation perspective as well. This might accelerate us getting to some of these targets that we've set around the world, and hopefully it does. There's other issues we have to think about. Where are foreign currencies held? Can they get confiscated by a central bank if there's issues there? And I think more broadly, if we think about, or locally, it's going to change the way companies operate as well. If these supply channels are likely to stay disruptive for a period of time, Does that require alternative sourcing of products? Do we think about where we take or get stuff manufactured and where we take it from? Do you have a more diverse base of where we get stuff from? And maybe you have to hold larger inventories so you've got stuff on hand just in case something flares up. So I don't think we can necessarily rely on the globalisation theme as a key driver of deflation that we've seen in the last probably 20, 30 years. I think that might be largely gone now. It's a watch and wait, I think, but certainly these issues can pass over time, but I think it's that perhaps the world order has changed a little bit.
Yeah, and I think, again, for listeners that are interested in this, there's some great implications that you cover in terms of inflation and supply chains for us here in New Zealand. And one of the positives, we've talked about a few negative things, is New Zealand is seen as a reliable place for food production and with good connections to the rest of the world. And probably case in point is dairy prices, which have been very positive through this period. And so have volumes of dairy exports have held up well. So hopefully there's some benefits in it for New Zealand as well. At that point, shall we turn to the local share market Australasia, I guess, as the market and the performance over the first quarter? It's been a tough start here in New Zealand, but a bit more positive over in Australia. What are some of the highs and lows when you think about how Australasian markets have gone over Q1, Craig?
Yeah, that's a great question, and there has been a big divergence, I guess, for the performance of both equity markets in the last quarter. And perhaps if we rewind the clock a little bit, it's probably been more than probably about a year or so that we've seen this divergence in performance of New Zealand versus Australia. And to characterise New Zealand, we have the New Zealand equity market as a relatively defensive market with around about 50% of the companies in the market sort of utility type companies or telcos, etc., which are influenced from a valuation sense by what's happening in the bond markets. And we've seen this large sell-off that we've talked about in 10-year rates that people use for a valuation sense. That's probably largely the reason behind New Zealand underperforming the last 12 months. Conversely, if we think about Australia, the lucky country that never does recessions, they have obviously a large hard commodity mix that they export around the world and to China and Asia, etc. And there's been a latent strong demand for commodities, and with the disruption was experienced in Russia-Ukraine, the pricing of those commodities has gone, skyrocketed up. And clearly Australia was a beneficiary from in terms of trade and revenue and tax take, etc. And there's obviously lots of other companies which hang off the resource sector more broadly, and that's obviously from a profitability perspective is great for those businesses. So I think Australia is probably in a better position than we are at the moment. Relatively strong employment like ourselves. The central bank is probably a little bit behind where our central bank is, albeit that's pivoted in the last day or so. It's amazing what happens when they take away a word, the word patient in their language, and it seems the market is getting ready for them to increase interest rates as well, which is probably likely the sensible thing to come.
Yeah, I think every trader had their finger on a button as soon as they saw that patient word get dropped. Yeah. They hit a button and markets have reacted pretty strongly and seem convinced that the RBA will be joining the RBNZ in lifting rates over the coming months.
Yeah. So I think from an investment perspective, it's in the portfolios, it's in place as well. We do have more of a bias towards Australia because some of those characteristics I talked about are looking more prospective than New Zealand. And some of those challenges, I guess, we're facing here in New Zealand that we're not fully open. We've got very tighter conditions, and the data is starting to roll a little bit in terms of confidence, business confidence, consumer confidence. House prices aren't going up anymore. And so some of those influences are clearly at the front of cost of living. And that's a large, I guess, problem for many people that's going to impact them through time. So we see short-term a better opportunity in Australia, and I'm going to go across to Australia in the next couple of weeks to there's a conference over there we go to the first time in person for 2 or 3 years. So it'd be great to get over there and experience what's actually happening on the ground in Australia.
Oh, that's awesome. And that's probably a good place to wrap things up. We've covered so much in this podcast. Apart from an international trip to get over to Aussie, what are some of the things you're going to be focusing on over the coming months, Craig?
Yeah, that's clearly a key focus. And then obviously we move into the reporting season, and there's going to be a lot of company announcements that come up sort of May, May, June is the pre-announcements by companies that might be finding things a little bit troubling. Confession season, we call it. And so we're going to get a bit more of a guide, I guess, in terms of how the listed corporate market in both here in New Zealand and Australia are travelling at the moment. And some of those influences we talked about throughout the conversation, I think, are going to come through, and we'll find out, I guess, the response by the companies that can mitigate it to some extent and the ones that can't.
Yeah, I think it's an interesting time, and I look at the period of March where all this uncertainty was around, and equity markets actually managed to perform reasonably well. So hopefully one of the things which investors take out of listening to a podcast like this is that markets are forward-looking. There's quite a bit of uncertainty around at the moment, but there's actually some things that are going quite well, and plenty of things for us to focus on. And as a final comment, I'd really encourage listeners to jump on Harbour's website and have a look at some of these fantastic reports that you make available to all investors. So thanks for joining me, Craig. It's just been a real pleasure to get some insights from you.
My pleasure, Chris, and it's been a great time. So we'll look forward to doing it again at some stage.
Perfect. That works for me, and I'm sure a lot of our listeners will be happy to hear from you again too. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.
If you've made it through the podcast and you're still listening, here comes the fine print. ASB Portfolio Series is a discretionary investment management service provided by ASB Bank Limited. For more information, see the ASB Portfolio Series Service Disclosure Statement available from your ASB Wealth Manager.